You are once again welcome to my channel. In today's video, I am going to be showing you how you can use the Fibonacci retracement to make money consistently in the forex market depending on your capital. With this strategy, you can be able to make over $200 daily in the forex market. So for you to master this strategy very well, there are some certain rules that you need to follow for you to be able to trade this strategy very well and become consistently profitable in the forex market. This strategy that I'm about to share with you in this video works in any pair, whether currency pair, whether crypto, whether gold, oil, any type of pair. This strategy works extremely well. So all you need is to understand how to implement it so as to be able to implement it very well. So now for you to trade with this Fibonacci retracement strategy, the first thing you need to take into consideration is the market structure. The Fibonacci retracement tool works when the market is in a trend. It can either be in an uptrend or in a downtrend. So the first thing we have to consider is to look at the market structure. So how do we identify if the market is in an uptrend? When the market is making higher high and higher low, we tend to understand that the market is currently in an uptrend. But when the market is making lower high and lower low, lower high and lower low, we know that the market is currently in a downtrend. So these are the different conditions in the market that you can use this Fibonacci retracement tool on. The Fibonacci retracement tool is not used during a sideways market. So take note, you only make use of this strategy when the market is trending, either in an uptrend or in a downtrend. Now, after understanding the market structure, the next thing you have to take into consideration is when to plot the Fibonacci retracement tool. So this is how you trade using the Fibonacci retracement tool. The first thing is to look at the market structure. So for you to be able to trade using the Fibonacci retracement, you need to understand market structure. So the market must be in a trend, either in an uptrend or in a downtrend. That is when you are expected to use the Fibonacci retracement tool. So the essence of using the Fibonacci is to be able to trade alongside in the direction of the trend. For instance, if the market is in an uptrend, the market tends to make a pullback before the uptrend continues. So the essence of the Fibonacci is to enable you to be able to enter your trade from the pullback. The same thing applicable to a downtrend. If the market is in a downtrend, the market tends to make a pullback up before the downtrend continues, and the Fibonacci retracement tool helps you to enter the market very well from the resistance level. So after considering the market structure and knowing fully well that this strategy works well during a trendy market, the next thing is to identify where to plot the Fibonacci retracement tool. So place Fibonacci levels from the most recent high to low in a downtrend. That is to say, if the market is in a downtrend, you have to connect the Fibonacci retracement tool from the previous high down to the lows and then extend it to the future. Now the levels that you are expected to look at are 0.382, 0.5, 0.618 and 0.786. These are the levels you should be looking at where market tends to reverse. So if the market is in a downtrend, you have to plot the Fibonacci retracement tool from the recent high to the lows and extend it to the future. But if the market is in an uptrend, then you have to plot the Fibonacci retracement tool from the recent low to the high and extend it to the future. And like I said, the Fibonacci levels that you ought to be watching is the 0.382, 0.5, 0.618, and 0.786. So after that, what you need to consider is to look at confirmation before you can enter a trade. So what is a confirmation? A confirmation is a candlestick patterns, because that is what will give you the confirmation for you to enter a trade. So if the price comes to a Fibonacci level and then get rejected, ending up with a rejection wick like hammer or inverted hammer, it gives you the confirmation that the price is respecting that level, and that is the level you are expected to take your trade. So that is why you need a confirmation before you can place a trade, and the candlestick patterns act as a confirmation tool for us to enter our trade from the Fibonacci retracement level. So in this scenario, the Fibonacci retracement is now acting as a support and resistance level. So the candlestick pattern will help us as a confirmation tool for us to have the confirmation that the price will definitely reverse from that Fibonacci level. Just like I said, if the price comes to the Fibonacci level and get rejected, forming a wick in form of a hammer or inverted hammer, that gives us a confirmation that the price is going to reverse from there. So then you have to wait for the candlestick that formed that rejection to close. So when the candlestick closes, by forming a wick, you enter a trade depending on the direction that the market is going. For instance, if the market is clearly in an uptrend and makes a pullback to the Fibonacci level, which will now act as a support level, so you wait for the price to end up with a rejection in form of what? In form of a hammer or a bullish pin bar. So you wait for the bullish pin bar to close for you to place your buy trade, and your stop loss will be below the level, below the Fibonacci level if the market is in an uptrend. So in other words, your stop loss must be below the support level, which is the Fibonacci level. And where will be your take profit? Your take profit will be at the previous high, the level where the price reversed from and start making a pullback. That should be your take profit. So these are the rules you need to follow for you to be able to trade profitably using the Fibonacci retracement tool. So now let's go to the chart and let me show you an example of how you can trade this Fibonacci retracement tool. So this is how a Fibonacci retracement tool looks like, right? Now you can clearly see that the market is in an uptrend, right? The market is clearly going up. The market is going up. So what you have to do is to plot out the Fibonacci retracement tool, and for the fact that the market is in an uptrend, you are going to connect it from the lows to the high, that is from the previous low to the high. So you can see that the market was going up from here. The market was going up, making sales of higher high and higher low, higher high and higher low, and then the market got to this high, right, and then began to make a retracement. So in this process where the market began to make a retracement is when you are expected to plot out the Fibonacci retracement tool. So this is the point where you are expected to plot out the Fibonacci retracement tool. So what you're going to do is to look at the previous low. So this is the previous low, right? This is the previous low. So what you're going to do is you plot out the Fibonacci retracement tool, connect it from this low, and then drag it to the highs, because this is where the market got to and began to make a retracement. So this is where you met the market, right? This is where you met the market. This is the highs that the market got to and began to make a retracement, right? So what you have to do is look at this previous low, connect the Fibonacci retracement tool, drag it to the highs, and then extend it to the future. So once you have done that, it will automatically plot out these levels. So these are the levels that I'm talking about: 0.286, 0.382, 0.5, 0.618, 0.764. So these are the levels you should be looking at, because as the market is making the retracement, the market is going to reverse from one of these levels. right? So as you have plotted out this Fibonacci retracement tool, you monitor the market to see where the market tends to range, because definitely as the market makes a retracement, there is a level where the market will get to and begin to consolidate. So if the market begins to consolidate at that level, it means that the Fibonacci level is holding onto the market. As you can clearly see, this is where the retracement began, right? And this is where the previous low was, and you connect the Fibonacci tool from this previous low up to the high and then extend it to your right, then automatically these levels will pop up. So now let's go to the second example. So now you can clearly see that this is where we were, this is where we met the market. So this was our previous low. So this is where we drag and drop the Fibonacci. We drag it from here to this high, and then we extended it to the future, right? So it gave us these numbers that you are seeing on the screen. So these are the Fibonacci numbers, right? So now as the price is making a retracement from this point, what you do is to monitor these levels 1, 2, 3, 4, 5. These 5 Fibonacci levels, you monitor them to know where the market tends to reverse from. So now you can clearly see that the market went down all the way to this 0.38 fib and began to consolidate. That is to say, the market was unable to break below this 0.382. So this tells you that the Fibonacci level of 0.382 is holding onto the price. So now what you are looking at is a confirmation to enter. So what was our confirmation? Our confirmation was what? A rejection at the level. So you can see the rejection. You can see the price came close and got rejected, forming this week. The price came close again, got rejected, forming this week. You can see another week. You can see another week. This another week. This another week. This another week. So you have multiple confirmation to tell you that the price cannot break below this 0.382 Fibonacci level. So if you are watching the chart clearly, you see that the price is unable to break below this Fibonacci level. So that means the 38.2 fib level is holding onto the price. That is the 0.382 Fibonacci level is holding onto the price. So you can either enter your trade here, here, or here, but make sure your stop loss is below this 0.382. So your stop loss can be somewhere here. Make sure the stop loss is below it and give it a little bit buffer so that it will be a little bit far away from the level where you are expected to enter your trade, because you are expected to enter your trade at this Fibonacci level, which is 0.382. So you can clearly see that these are the levels where you are expected to enter your buy trade. So once you place your buy trade at this level, your stop loss must be below this 0.38 Fibonacci level. And where will be your take profit? Your take profit will be at the previous high, where the price reversed and started making a retracement. So this should be your take profit, right? So you enter your buy trade here, your stop loss will be below this 0.82, somewhere here, and then your take profit will be here at the previous high. So you can see that the price ranged a little and began to rally up and then smash your take profit. So this is an example for an uptrend. Let me show you another example. All right, this one is for a downtrend. This one is for a downtrend. The previous one I showed you is for an uptrend, but this one is for a downtrend. So now if the market is clearly in a downtrend, all you are going to do is to connect the Fibonacci level from the highs to the low and extend it to your right, just the opposite of an uptrend, right? Because in an uptrend we connect from the lows to the highs and extend it to the right, but in a downtrend we connect from the highs to the lows and extend it to the right. So now you can clearly see that the market is in a downtrend, right? So this is the lowest point that the market got to, and this is the previous high. This is the lowest that the market got to, and this is the previous high. So this is where you made the market. This is where you made the market. You can see that the market got to this point and began to make a retracement. You can see these two green candle telling you that the market is making a retracement from this level. So what you are going to do is to look at the previous high, the most recent high, which is this. So this is the most recent high. So now that you have seen the most recent high, what you are going to do is to plot out the Fibonacci retracement tool and connect it from this high down to this low, and then extend it to the right. You connect it from here down, you just connect it here, you drag it down to this low and extend it to the right. So once you do that, it will automatically plot out these Fibonacci levels. Like we have the 0.236, 0.382, 0.500, 0.618 and 0.764. So these are the levels you should be looking at, because this is the level where price can reverse from. So now the level has been plotted automatically. What you have to do is to exercise patience and monitor the levels extremely well to see the level where the price tends to consolidate, because that is the level where price will reverse from. So after plotting out the Fibonacci tool, the next thing is to monitor the chart to see the level where price tends to consolidate, where price cannot be able to break above. So that is where you are expected to place your trade. But before that, you need to look at a confirmation. Like I said, a confirmation can be in the form of candlestick rejection, like an inverted hammer or a bearish pin bar. So these are the confirmation you are looking at the Fibonacci level to confirm that the market or the price cannot break above the Fibonacci level. So now that you have plotted out your Fibonacci tool, so let's see what happened next. So you can clearly see that the price now went up to this 0.234, broke above it, came to this 0.382, broke above it, and then came to this 0.5 and then got rejected, forming this wick, right? So you can see the rejection, see the rejection that I'm talking about. So this is the confirmation that you are looking at. Once you confirm this, then you can now enter a sell trade, because this tells you that the price cannot be able to break above this 0.5 Fibonacci level, right? So now the price has ended up forming an inverted hammer, or should I call it a bearish pin bar. So you simply wait for this candlestick to close. Once it closes, you place your sell trade, and your stop loss must be above this level, this 0.5 level. And where will be your take profit? Your take profit will be at the previous low. So this should be your take profit. This is the level where the price began to make a consolidation. So this should be your take profit, because this is the level where the price can still react, because this is clearly a support level. So for you not to lose your profit, you have to make sure that you place your take profit at this previous low, right? So you can clearly see that the price went down, smash our take profit, and then continue to rally down. So as a trader, you don't need to be greedy. Just take what the market gives to you, and that is it. Once you understand this type of rule, you'll be able to make money consistently in the forex market. So this is how you trade using the Fibonacci retracement tool. So my advice for you guys to go to a demo account and backtest this strategy. If the strategy is working well for you, kudos. You can then use it in your real life trading account. So this is all I have for you in this video tutorial. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I drop new content. And like I told you, we are going to be having this section weekly every Sunday. So I will see you again next week Sunday for our next tutorial video. Enjoy the rest of your day. Goodbye.